To complete our lecture, I mean my voice lecture to you, there are some ratios and rates that we can use for assuring that the risk on the bank with regard to the loans or the credits offered to the units are at the minimum. These ratios and rates are related to net working capital items, related to inventory and debtors, related to profitability, and related to what is we call the funds and the loans, funds and funds invested. Ratios and rates associated with funds invested. After these ratios, we may have horizontal and vertical analysis, as well as some other advanced statements we are preparing to assure the ability of these entities for paying debts. Let us begin by the ratios, and I told you we will begin by the first example. The first example in page 162. He asked for preparing all the ratios and rates related to the net working capital. The net working capital includes three main ratios and rates: the current rate, the quick current rate, and the liquidity rate. How can we calculate these rates? It is well known that all of the three means that I have a denominator that is current liabilities. So for the three rates, the denominator is the current liabilities, but the numerator in the first rate is current assets. In the second rate is current assets after deducting inventory and bad debtors, not bad debts, bad debtors. So debtors, but we are not sure that they will pay the debt on them. The third one, just the liquid assets, I mean cash, and cash does not mean cash on hand, but cash on hand and cash at bank. So if we consider this example, the total of the current assets 270, the total of current liability 120. So current assets to current liabilities 270 to 120 gives 2/4 to 1. 1/4 to 1. This rate is acceptable as if it is about 2. So 2 to 1 or 2/4 to 1 is accepted. The quick current rate means that I will divide by 120 also. That is the current liabilities. But what about current assets? I want the quick current assets. The quick current assets means current assets minus inventory and bad debtors. The bad debtors, he told me that 8,000 and inventory 70,000. So if deducted from 270, I will get 192. If its rate compared with, or if this quick current assets compared by current liabilities, it gives 1.6 to 1, and it is accepted round 1.5 to 1. With regard to liquidity, it is accepted if it is about 1 to 1. Here, the cash and bank 132. If I get the rate to the current liabilities 120, it gives 1.1 to 1, so it is accepted in this way. Okay, we are going example 3, and example 3 relates to profitability. Which profitability? If dividing profit to investment, so profitability of investment. Profit on capital, so profitability of capital. Profits on sales, so profitability of sales. Profit divided fixed assets, so profitability of fixed assets, and so on. Example 3, page 165. He asked, you are required to calculate the different ratios of profits using the following available data for a certain period in one of the economic entities. Values are in £1,000. Net profit 225,000. Net sales 1,800,000. Invested capital 1,500,000. Total fixed assets 1 million. Property rights, that is equity, 1,200,000. Short-term liabilities 400,000. Based on the previous data, you are asked to calculate the profitability of the different mentioned items. So, profitability of invested fund capital or invested capital, net profit divided invested capital times 100. All these ratios will be times 100 to get a percentage. So it equals 15%. Sales profitability equal net profit divided net sales times 100. It gives 12.5%. Profitability of fixed assets, net profit divided total fixed assets times 100 gives 22.5%. Equity profitability, net profit divided equity, it gives 18.75%. I'm asking, can you deduct that current rate is 2.25 to 1? Try to conduct it, or even if we will get live lectures, we will explain it to you better than this. Then we have example 4 related to invested fund. These are some ratios related to the fund invested, and this is in example 4, page 167. Through the following available data with respect to a certain entity which is intending to request a bank credit, you are required to prepare the available ratios and rates related to funds invested. Values are in pounds. Net sales of the period, funds invested including 800,000 as gross equity, gross assets 1,500,000, of which current assets equal 500, net profit before tax amounted to 70, and interest on loans equal 60,000. Based on the data shown through the above example, we can extract the following ratios and rates. The ratios of equity to gross funds. So equity will be divided by gross funds. Gross funds means all the funds invested, either owned or borrowed. It gives 64%. The ratio of long-term liabilities to equity. This is a very important ratio. Dividing liabilities, long-term liabilities by equity, it gives 56.25%, and this is not acceptable because the long-term loans is more than the number or the value of equity itself. Net sales rate to equity, net sales rate to total assets, net sales rate to fixed assets, net sales rate to current assets, the ratio of current assets to fixed assets, the interest burdens coverage time. It gives you the number of times that I can settle the interest on loans. After we have two cases for vertical and horizontal analysis. Look page 169, 176. Horizontal analysis means taking the difference between the value of one item in 2 years and dividing by the previous year. But the trend analysis, the vertical analysis, means that I have many items and their total. So dividing the value of each item to its total. So this is vertical analysis. So vertical analysis taking each item in the total of these items. But horizontal analysis, each item, it was a certain value, it became another value, the difference to be divided by the previous year to give me the horizontal analysis. Now there is what is called the trend analysis example, page 176. 176, trend analysis. He gave me the years from 2011 to 2018 or 2008, 2015, it doesn't matter. And he gave me the values of sales and the values of inventory, and he wants to see the trend analysis. We begin by sales. Quantity of sales 9,000 in the first year. It became 8,000, so there is decrease of 1,000. It became 7,500, so there is decrease of 1,500. The 9,000 became 7,200. There is a difference 1,800. The 9,000 in 2012 became the same 9,000. So the difference is 0, and so on. The change will be divided by the 9,000 to get the changes percentage as it is shown in the third column in the sales item. The same will be for inventory to get the changes and the changes percentage from the base year, that is 208 in this example. Now we have what is called advanced additional statements in the frame of financial analysis. For illustration, there is an example in page 179, 183, but it cannot be explained clearly in a voice lecture. So we will try to explain it when we meet together in our class, inshallah. Then accounting analysis through the analysis of the relationship between cost, volume, and the profit. For illustration, look page 183 and 185, or 183 to 185, and we explained it through